Okay. Welcome to Infinity Forum podcast. Today we're going to focus on wealth management. With me, I have Daniel Beckerman. He's not only my wealth manager, but we have been to same school. So we both are alumni of Columbia University. We did wealth management courses there. Additionally, Dan has plethora of experience. I'll let him introduce himself, but he also had gone to Yale. And then he has been he has been in wealth management business for a long time. So Daniel, so happy and honored that you are talking to my Infinity Forum members today. And we wanted to do this pre-record broadcast in a way that the topics we cover today would be a thought starters for the forum members. We are going to meet September 27th. We want it to be insightful, thought provocative, so that they come back with more questions and they do their wealth management better. With that said, why don't you start off with an introduction and also answer a question on what does wealth management mean to you at a broader perspective? And also want to know about your passion. How did you get into this career and everything about, little bit everything about you? Thank you.
Sure. Yeah. So those are great questions, and it's an honor to be here with you. Thank you for inviting me to the podcast. And I think that whole desire to try to improve people's lives with financial planning is really what gets us out of the bed in the morning for all of us here at the firm. From a background perspective, I have 9 financial licenses and designations, Series 7, 63, 65, 31 life and health insurance licenses. I'm a certified financial planner, a chartered financial consultant, and a certified private wealth advisor. So for the CFP, that's sort of in our industry something that a designation that people look for. If you are getting an accountant, you may choose a CPA. If you are going to work with an attorney, you may choose to work with a JD. CFP means that we have post-undergraduate education in various disciplines of financial planning, including retirement planning, asset protection, estate planning, tax planning, and comprehensive financial planning. And I think one of the things that distinguishes, when you're looking at different types of financial companies, for us, we're also a fee-based registered investment advisor. And the RIAs are legal fiduciaries that are legally required to put the client's interest ahead of our own interest. So a lot of people will choose their financial advisor. They may work with a brokerage firm. And there are wonderful brokers, by the way, at all different companies, like a Merrill Lynch, a Morgan Stanley, a Goldman Sachs. They may work with a bank like Wells Fargo or Chase, or an insurance company like AXA Equitable or Northwestern Mutual. But a registered investment advisor, the difference, and people may not realize, is that they may be sold certain products. So that if the client says, well, is it in my best interest to buy a property or to invest in a business, even if it's not in our interest to recommend those things, we're going to recommend them to the client. So I think, and the definition of wealth, Usha, your question, you had emailed me this ahead of time, and I got to thinking about that. A good friend of mine once said that true wealth is all the things that money can't buy and that death cannot take away. So we think about all these kind of things that are not just, what am I doing with my portfolio? So many investors tend to think about doing their wealth management based on, well, what is my portfolio going to do? What am I going to choose to invest in? Do I have the right, mutual funds or ETFs? Do I have the right mix or the right stocks? And it kind of ends there. And the way I explain this to people is that there are various disciplines when it comes to financial planning. So we've got, investment planning, of course, right? How do we make sure that for the level of risk that you're taking, that you're optimizing, you're getting the most competitive rate of return? And when we think about retirement planning, we tend to think about how can we make sure that when you get to a point in time when either you choose not to work anymore or you just can't work anymore, can you generate all the income that you need, including healthcare expenses, even if you're not employed? And are you taking advantage of tax deductible retirement plans? Estate planning has to do with making sure assets are titled so that you're leaving what you want to who you want when you want in the most effective way possible. And then, of course,
Mhm.
asset protection is another concern. How can you be sure that assets are titled so that you're going to protect against various kinds of creditors, bad relationships, and so on and so forth? Each of the areas of planning are interrelated. So when we're dealing with clients that are making decisions about their real estate decision, for example, well, that's going to impact their retirement plan. It's going to impact their estate plan. It's going
Absolutely.
to, all these different pieces. So what we try to do is look at that whole picture, tie it together, make sure they are making what we would think as optimal decisions, uh,
Mhm.
and trying to point them in the right direction. So, like our saying is that here in the office, we say most people will make decisions uh, at the kitchen table, but not with
Yeah.
an Excel spreadsheet. And
Yeah.
so we want them to try to think about, the optimal way to go in these different areas. And just really, really quick, the way I originally got into this business, my passion, my grandfather bought me a portfolio of stocks to get through college. um, my mother was a teacher, my father was a social worker, and finance was this really foreign concept, and we had no, my family had no idea how to optimize these things. But I really wanted to figure out, well, maybe understanding this was the key to, and it became, just a lifelong journey to understand finance and to help people improve their lives with good financial planning.
Absolutely. Love the answer. Love the response, the details you went into. I love how you define wealth management. Can you say that again? It's something for everybody to think about. And that's the most profound statement of wealth management I've ever heard.
Right. So we think about true wealth, and this didn't come from me. It's a good friend of mine who's also in finance. He said, true wealth is what money can't buy and
Hmm.
death cannot take away. And when I
Right.
started to plan for, say business owners and families, the conversation is often far beyond what they're investing in their portfolio. They're oftentimes concerned about a legacy.
Right.
Um,
Absolutely.
how can they make sure that their kids and their grandchildren are well taken care of? Um,
Yep.
you know,
Yeah.
uh,
Legacy, the value, as a family, you have certain values, certain culture, all that could be part of your platform, which defines what wealth management means for you as a family, correct?
Absolutely. Oh, that's
Yeah.
it's such a good point. And there's so many aspects of this
Mm-hmm.
conversation.
Mm-hmm.
Um, there's a proverb, here in the US, we use shirt sleeves to shirt sleeves.
Mm-hmm.
In Japan, they use rice paddies to rice paddies. In Scotland, they say the father buys, the son builds, the
Yeah.
grandchild sells, and the son begs, and his son begs. So, and in China, they also have a saying that basically translates
Mm.
to that wealth never survives the third generation.
Absolutely.
And so we kind of like to think about, why is that? What are the values? How do we make sure that our children and grandchildren are in a position that they themselves can be successful? I love this when we had this conversation and you talked to me about the importance of getting, children involved in financial
Yeah.
planning and wealth management and the impact that
Yeah.
that's had on yourself. And I see that as well with my own children and certainly with our clients'
Mm-hmm.
children. And
Mm-hmm.
it can be a big challenge because the first generation is going through this hardship, they're building wealth. The second generation is witnessing the parents struggle. But by the time you get to the
So,
third generation, right, they don't have any memory of that
yeah.
kind of
Yeah.
struggle, the process that it takes to understand
Yeah.
savings and
Yeah. Yeah.
so on and so forth.
Yeah. That's something we can ponder on. My Infinity Forum, we can talk about it, and defining wealth management, what it means for each family, which might be very different.
Right.
It's not one size fits all for different things you just mentioned. So also at the beginning, you mentioned a lot of my members also are clients of Fidelity or this banks who have been doing their financial planning and wealth management. What are the questions they should ask so everything is done in their best interest? And I wouldn't say victim, I had a similar experience where people were trying to sell me annuities and products that benefited them more than me. And I realized I learned it the hard way. So
Right.
you can send me some information or questions they should ask afterwards, after the podcast, which I'll share with my forum to
Mhm.
avoid such circumstances and making sure everything is being done in their best interest. So I
Yeah.
would love that. And
Yeah.
then the topic another next question I wanted to ask you about was alternate investments. Nowadays, wealth management initially was defined very narrowly. The amount, kind of the investment vehicles we had were limited for a retail investor or
Right.
even going through a wealth manager. Now we have so many options, so many alternatives. In general, I want to get your opinion on what do you think about all this alternatives, so many financial products that are coming up in the market. Which ones are the shiny objects? Which are the ones that are going to stay? What's your opinion in general?
Yeah. So it's an interesting evolving landscape of alternative investing. We had this year, as part of the an executive order that was recently passed by Trump that allowed uh, various kinds of alternative investments to be included in what are called ERISA plans, which include 401k plans, which were never allowed before. So we're clearly seeing an opening up of that industry. We're seeing more and more investment within that industry. By the way, that includes cryptocurrency, which has become a huge part
Hmm.
of the financial industry in the last several years. But also private credit, private equity. These have
Yeah.
become massive in size. And part of this has been after a run up of many years of strong performance. So I believe it's a double-edged sword because
Mhm.
you're kind of making these alternatives more open and available. I think that
Mhm.
can be a huge positive for alternative investments that actually do have value. But for the individual person, it can be hard to distinguish, right? I think Coinbase at one point had hundreds of cryptocurrencies. What are the odds that they're
Yeah,
all going to be,
absolutely.
having this level of exponential growth as opposed to, a whole number of failures? And I think there has been a model. There is a book on this called Unconventional Success.
Mhm.
Yale had a very famous endowment investment platform that was very successful for 2 decades, all through the 80s and 90s, 2000s. Um, and they had very strong performance. Many other university endowments adopted this model of investing more and more in alternatives. So they would invest in certain types of
Mhm.
hedge funds and private equity and so on and so forth. Um, in reality, in recent years, so if you go back the last several decades, yes, private equity has performed quite well. Most alternatives have underperformed what the market has done, and many university endowments nowadays are sort of questioning, should we be investing in alternatives? A lot of people don't realize this,
Mhm.
but the average hedge fund, and there are studies on this, there's a company called Pivotal Path that has an index of all different hedge funds. How do they
Mhm.
perform relative to the market? And the majority of them have by far underperformed just a very simple 60-40 portfolio of stocks and bonds. And they've done it for
Mhm.
very high fees. Uh,
Mhm.
Many
Yeah, I
investors will describe this kind of uh, illiquidity factor because you're supposed to get a premium, right? If I'm investing in something that I can't just easily
yeah,
sell the next day, I should get
yeah.
paid more to do it.
Mhm.
And many hedge funds, actually, in fact, most hedge funds have underperformed that in just what the market has done. And when you factor in the high rate of fees,
Mhm.
they've by far underperformed. There's a
Yeah.
famous investor named Ed Thorpe, and he ran a very successful hedge fund There's a book on him as well. He also invested in the hedge fund manager Citadel. So Ken Griffin, who's one of the most successful hedge fund managers in the
Yes,
world,
yes. Yeah.
Citadel's fund was doing like 14% a year. And
Mm,
Ed Thorpe said, well, and he's a very smart mathematician and financial expert, and he did a lot of analysis and said, even with these very high rate of returns, if I
mm,
factor in all the turnover that they're doing and all the fees that they're charging me, I'm better off just investing in the S&P. And he went there.
yeah.
So
Yeah.
one of the questions for investors, if I'm investing in a strategy, is that particular strategy, does it need to be in some alternative format with a high fee?
Mhm.
Or is there some way that I can access a liquid form? We invest in a lot of alternatives that are liquid. Can we do that for a much lower fee? If a strategy, for example, is buying some stocks and bonds, or buying and selling stocks,
Yeah.
does that type of strategy need to be in a high fee wrapper? And I
Mhm.
think that's an important part of the conversation. Also, private equity has largely benefited from the debt market having been as attractive as it has for many years,
Mhm.
because interest rates from, if you look at the last sort of period where we had large, they call it vintage in the private equity industry, where you had this large investment of levering up companies and trying to take them private and then rebring them public. That worked very well when interest rates were lower. Now that we're in an environment where corporate borrowing is much higher, more expensive, it makes it more difficult to do well in that market. So it really depends on the strategy.
Mhm. So, I know the you shared this details with me also when we were doing our own planning. Um, Lately, however, we see, I don't know, it's a trend. A lot of people with wealth are splitting between the private equity. There's more and more money being put in private equity. Why do you think that's happening? And you think you still the percentage wise, if you look at how much money is going to private equity, it's been it has been increasing
Mm,
year over year. So I see that trend and wanted to know your opinion on that. And also, not everybody has access to the private equity at the same level, right? There are groups
right.
of people. You have to be part of a investment fund or things like that. So if you can
Yeah.
do a little bit deep dive on that, it'll be helpful. Yeah.
Yeah, absolutely. So the private equity market, I think what's interesting, if you look at hedge funds and private equity, if you actually look at performance
Mhm.
in the stock market or in certain kinds of businesses, it's oftentimes smaller companies that are more nimble that have a higher rate of growth, right? There's this size premium in the stock market. And that's not really true in the hedge fund market. There's a lot of bad hedge funds. There's a
Mhm.
lot of bad private equity investors. It tends to
Mhm.
be the biggest companies that have had, the most successful track records. We do have to be really careful in analyzing the data because there's a lot of survivorship bias. I think a lot of
Mhm.
the interest, the attraction in private equity has to do with where you are in a cycle of performance. One thing I've learned
So,
in since I was licensed in 2000, so the tech bubble crash and then the financial crisis, money
yeah.
always chases performance. So,
Mhm.
for example, in after the financial crisis in 2008, everybody wanted to invest in managed futures. Why? Because it was uncorrelated. The
Mm.
investments went up as the market was going down. Um, that was the most attractive investment. And of course, money chased the performance at that time. Then it had very bad performance. What I
Mhm.
should have been buying as an investor is what had already done badly. In other words,
Mm.
stocks had crashed. So if I
That's
was
right. Yeah.
buying, the bank stocks when they were a dollar, Citibank was a
Mhm.
dollar, and so on and so forth, right? That was really the opportunity. So
Yeah.
um, if we understand valuation, and that's one of the things that I learned studying value investing, is if you look at what Benjamin Graham, who was also at Columbia, was Warren Buffett's teacher there. He always talks
Mhm.
about understanding the value of what you're buying. So if I know that I'm buying something that I'm valuing at a certain price, and the market's told me, well, it's out of favor, it's down, it's already gone down. If I feel that I can pay less than the intrinsic value of what it's worth, I feel like I can make a lot of money. Of course, there are many investors that do that successfully, that are value investors, but
Mhm.
that's a bit of a different field. There are really solid private equity and venture capital investors
Yes.
that I have
Mhm.
done well and will continue to do well. But it's the problem is that it's sort of like the IPO market, where you don't want to be a member of a club that will have you as a member, right? Because if you're investing in the best private equity investments in the world, and venture capital investments, yes, you're going to do well, but it's very hard to
Mhm.
get into those things like Renaissance
Right.
Technologies, successful quantitative hedge fund. Well, it turns
Yeah.
out you can't get into the Medallion Fund. You can't get into the
Yeah.
best
Yeah. Yeah.
Citadel Fund.
Right.
So, but if you have a bad investment, private investment, you can get all the shares that you want of that. So, uh,
So true. And
yeah.
that's the struggle I felt too. Very well said. Thank you. Thank you for clarifying or giving your perspective on that. Moving on, I think the next thing we wanted to talk about is um, uh, compared to, I think, last year, this year, a lot of changes have happened. And what are the things are different or opened up for investments so people can take advantage, which was not a possibility a year or two ago?
Yeah.
Yeah.
There's a big change in various kinds of alternative investments. There's actually, ironic as it sounds, a
Mm.
publicly traded private credit strategy in an ETF format. So
Yeah, yeah,
uh,
yeah. I've
there's
seen that.
yeah, and then there are different kinds of cryptocurrency investments that are available in ETF formats and so forth.
Right.
So what we've seen in the last year in terms of optionality, there's more and more of a democratization of finance than ever
Hmm. Hmm.
before.
Yeah.
And I think the current administration is sort of very open to all these kind of new technologies, new things. Again,
Hmm.
of course, it is a double-edged sword. There are people that will make the wrong kinds of investments in these fields and lose money, but it does create a whole new kind of area where that's opened up for investors. From a planning perspective, of course, there are new directions that we always think about as financial planners, right? When there are tax law changes. So the One Big
Hmm.
Beautiful Bill essentially extended the tax law that was put into place in 2017 under the original Tax Cuts and Jobs Act provision. So, for example, extending tax rates, increasing the estate tax exemption,
Yeah.
we had an increase of the SALT cap depending on a person's, which are the deductibility of state and local taxes depending on the person's income situation. Um, so all of those, there are new tax deductions for seniors. All these things have various kinds of planning implications that we, as financial planners, will tend to think about. Um, I
Yeah.
think, yeah, I think in another sense, right? There's also a lot that hasn't changed. There's a lot that's in common with, I was recently reading one of the books called Security Analysis by Benjamin Graham, who I had mentioned. There are some famous hedge fund managers, Seth Klarman, most notably, who participated in this book. And of course, there are many things that have changed in 100 years, but there are certain kind of principles, right? Understanding the value of what you're investing in, not just looking at the trends of what's changing in price, but understanding, what makes a certain type of stock attractive. How do I look at a financial statement and think about various line items, whether it be looking at the income statement, the balance sheet, the cash flow of that organization, the importance of really understanding growth and value, how to come
Hmm.
up with some way to value companies, how to think about bonds, and what is a sound decision? How do I think about protecting my principal when I'm investing?
Hmm.
In some ways, right, just good corporate finance principles are still very valid today as they were many years back. So a
Yeah.
lot's changed, but a lot has stayed the same.
Yeah. Yeah. So speaking of that, right, lots changed. Technology is one of the big change force in financial markets and wealth management as such. So what are the
Mhm.
things you would think are something, you said democratization of a lot of the financial products available for retail investors now through different platforms is something we are all are witnessing. So,
Mm.
what are the pitfalls? What are the things we should watch out, and what are the things we should embrace as new technology is coming in? Um,
Yeah,
any thoughts on that? And I mean, it's
yeah.
always nice our wealth manager to take care of all of it, right, and educate us.
Mm.
That's one of the benefit of having a wealth manager to strategize around that. But in general, for us to build, to
Mm.
know or build knowledge, what are the things pitfalls um, we should be thinking about or be careful about here.
Yeah, I do think it's extraordinary the advances that we've seen with artificial intelligence, and I
Mm,
remember when ChatGPT started. I started first playing with it and seeing some reports of how it could be used, and thinking, when I talk to other experts in technology in the past several years, they say, "Oh, this is many years away before we'll see any kind of sign of some beginning piece of artificial general intelligence." And of course, it's happened very quickly.
yeah.
I think overall, it's a one has to keep up to date with what these technologies are, what they can do, how they can help support you in what you're doing, whatever that is, whatever that field or role is. So, there's always kind of the question about, well, does this kind of help or hurt you in a
Mm,
particular field or in a particular area that you're working in? So I think I tend to lean toward this direction that it's a huge positive. When
yeah.
I go back to my experience, uh, and I think about founding my company, for example, in 2006, um, it wouldn't have been possible for us to, as a firm, to accomplish as much as we have with the amount of people that we have. We need a lot more people and so forth. It would be really difficult without the help of technology. So
Mhm.
all of the kind of resources that we have, all the various kind of technology tools that we have, make doing what we do, essentially much more effective. It makes us more productive, and so forth. Um, I think from an investment standpoint, we kind of there are certain things that are becoming, with the advances in technology, more and more
Mm,
commoditized. So, for example, what's a kind of general appropriate asset allocation, and what's my risk tolerance, and how do I assess these things? Right, that's becoming less and less important. And when we have clients that we're working with, oftentimes it has nothing to do with
mm,
the field of just trying to optimize their investments. It could be that they run a business and they're worried about stock options and corporate stock hedging and 12b5-1 plans and net unrealized appreciation and business succession planning and corporate various kinds of tax saving schemes, um, and so forth, qualified plans. um, so, for us, I think in a way, it creates an opportunity where the conversation and the planning that we're doing with clients ends up getting much broader, which tends to, I think, benefit people to a larger degree. There are some cases where people will rely on technology. I've seen this myself, right? My son doing
mm,
homework is like, "Oh, I
yeah.
got all the answers. ChatGPT, help me out." And I'm
Yeah.
looking at some date, and I'm saying, "Well, this didn't happen on this date. This is not entirely accurate." So,
Right.
I
Right.
think it's still at a stage where um, there are certain kinds of things where if I'm getting heart surgery, or I have, I'm buying a property, I
Yeah.
probably still want a doctor and an attorney to help me with those things. Um,
Yeah.
Maybe, they're going to go and check. Maybe I'm going to go look up, ask ChatGPT, well, what does this all mean? And try to have a more informed perspective. But I think in a way, these tools enhance the relationship. I think it is a risk for people that are not adopting the new technologies,
Yeah.
that are available that aren't making use of them, they're going to, tend to fall behind. So, and it does create more opportunities for people to be served with technology solutions. In all fairness, there are wealth management solutions that people can find online,
Yeah.
and robo kind of investment things, and other,
Yes.
there are online legal strategies people can use. And I think those are a really good tool, especially for someone that maybe doesn't have a lot of complexity, and
Mhm.
maybe doesn't hasn't built up as much wealth or business interest yet, and so
Yeah.
forth, and they just need very simple advice, and they don't have the money to go, enough money that it makes sense for them to go find a wealth advisor to help them with that.
Gotcha. Thank you. Thank you for that in-depth discussion on technology. My last question, and I want you to cover anything else you think might be important for my forum to discuss or talk about. But from my question standpoint, the last one I wanted to ask you was wealth management itself as a strategy, defining a wealth management strategy for an individual,
Mhm.
different life events. There are different trigger points in life where we have to revisit or redo it or do it again. Can you
Mhm.
explain how does wealth management, the life cycle of wealth management for a person should be as they're progressing in their life?
That's a great question as well. um, I think for us, it all follows this kind of human capital and then financial capital flow. And I always explain this to young people, especially, is that, when you're starting out in life, most people, now maybe if we're lucky, some of our kids and grandkids will inherit a large amount of wealth, but most people start out without having very much wealth, right? And
Right.
their opportunity set, their future, it all consists of human capital. And then over time, they have less and less time, right, in their life left, and eventually they run out of human capital, and they're accumulating and eventually relying on that financial capital. So
Right.
doesn't it make sense for them to get better and better at managing that financial capital, at making sure they can be effective, make effective decisions when it comes to that capital? So to us, educating the client about how can they, oftentimes when we think about these life events that you mentioned, right?
Mhm.
Oftentimes people, what I find is people have a good idea as to what they would like to achieve. But if they're not literate in finance, they don't really have the tools to express what they think they would want to have happen. So they may rely on someone else to do it. And like you said, if they're going to a brokerage firm that's not a fiduciary, that's just selling them a product, then they're walking in the door with concerns about maybe a real estate transaction or their child's education, and they're being sold some sort of product, whether it's an annuity or insurance or some other thing. Um,
Right.
so, so essentially, when we think about those life events, um, you know, anything similar to estate planning, right? Anything
Mhm.
that's going to change the fabric of their planning, which are, essentially things that have a dollar sign attached to it, and the larger the dollar sign attached to it, the larger the human capital decision is going to be, the more
Mhm.
impact that's going to have in the different areas of their financial planning. So it could be a job change, it could be anticipating retirement, it could be having children, it could be saving for their education, thinking about passing on income across various generations. And each of these areas of planning, there are different considerations. So we have tax planning, we have estate planning, we have asset protection. And when we deal with successful people, which we mainly do, that have complexity, that tends to be our clientele, there's often a competition for assets. So there's not
Mhm.
one simple answer that they're walking in and someone's recommending this investment. This is your end all solution. In
Right.
reality, right, maybe that person should pay down their mortgage. Maybe they should save money for a down payment on some other property. Maybe they should invest in their portfolio. Maybe they should be buying some sort of life insurance policy if it's a young person that just started in their job and their family's relying on their income. Maybe they should
Mhm.
be thinking about, saving for a 529 college education plan for their child, or
Mhm.
maybe they should be saving more in their retirement plan, right? There's all these different ways they can be investing. So there's this
Mhm.
competition. What is the optimal place for people to be putting their finances? And there's not a one right answer for everyone, but we have ways to kind of
Mhm.
illustrate to the client. I like to use data visualizations, make it more clear
Mhm.
to them what are the directions that they may want to consider going in, and then hopefully they can make the right decisions as to what kind of ways that they might want to allocate capital and
Mhm.
protect themselves from various kinds of risks.
Wonderful. I don't know if you have time. If you have time, if you have anything else to add, Dan, I'll leave it to you. But my final thought was also we wanted to talk about the macroeconomics or
Sure.
the global, the opportunity now, which are more global opportunities that are available for investments or wealth management. So that is
Mhm.
something you can talk about, or anything else you want to add to our
Yeah.
discussion, please.
Thank you, Usha. I appreciate that. Yeah, I think that's a great topic. This globalization trend. I mean, to us, as you know, that's a major sort of positioning. An area that we've gone into in a large
Mhm.
way is kind of increasing our international exposure over the past year. And I think this comes down to how various kinds of financial markets are behaving, where valuations are, where are we coming from. Um, and I think it's interesting to kind of look back at history. If we look at global market caps, if you go back to, let's say, 1987, the US at that point represented about 30% of the global market cap, of the world. And today, the US
Mhm.
represents about 65% of the global market cap of the
Wow.
world. So we've seen this huge
Wow.
decline in other parts of the world. Now, there are some good
Mhm.
reasons for that, right? We have the best technology companies in the world. We have a
Mhm.
certain kind of rule of law. We've had generally, attractive financial market cycles, especially since the after the financial crisis. Um, but I think the trends got a bit extended, right? It used to be that
Mhm.
if you go back prior to 2008, about every 3 or 4 years, you'd see some outperformance in the international markets, then you'd see the US outperforming, and vice versa, right? Every number of years. And this went back to, about post World War II era. But for the last, 11 years, essentially in a
Mhm.
row, the US has dramatically outperformed other markets, and
Right.
that's left the US at a premium. So if you're buying, even if it's a similar company that you're investing
Yeah.
in outside the US versus the US, right, you're going to pay in general a large premium for the US businesses because, again, people have already experienced that run up. And
Mhm.
we see, amazing opportunities and valuations in other parts of the world. I think the last couple of years ago, Warren Buffett has invested in and increased his investments in certain parts of the world outside the U.S.,
Right.
Japan in
Yeah.
particular, which
Japan.
is
Yeah.
very, by the way, that's very unusual for Warren
Mhm.
Buffett to have done that.
Mhm. Mhm.
Um, but it's because of those high valuations. We actually started
Mhm.
investing in Japan, some of those companies before
Mhm.
before we knew
Mhm.
that Buffett was. But I think there are many others that he will find, or
Yeah.
that now that he's retired, it'll be his team, the other hedge
Yes.
fund
Yes. Yes.
managers
Yes.
there.
Yes.
Uh,
Yes.
so I think that's an important theme. Looking
Mhm.
for, just in general, looking for opportunities in something that hasn't already done very well. And I
Mhm.
guess one point I can leave you with also is, if you go back to 2000 and you
Mhm.
think, even if you knew all of the most exciting and best technology trends that have existed over many years, and if I told
Mhm.
you, well, mobile phones would become, a huge kind of business opportunity, cloud computing and so forth, who would you
Yeah.
invest in back in 2000? Well, you
Yeah.
might say, well, I'm going to invest in the best technology companies. The best phone companies are Palm Pilot and Motorola. And the best technology
BlackBerry.
companies, yeah,
BlackBerry.
BlackBerry,
BlackBerry.
yeah, yeah, the best technology, and I'm gonna pick the best tech companies were AOL, Time Warner,
Mhm.
right? And Apple, by
Mhm.
the way, wasn't even in the phone business.
Yeah.
You had, Lucent Technologies. They were going to build the infrastructure of the internet. So all of these, even if you knew where the trends were going, you still would have done very badly owning all the best companies, which as IBM was very big back then, by the way. They're a shadow of what they used to be in terms of
Yeah. Yeah.
relative to the technology world. So, I think there's an important lesson there that as
Hmm.
investors with disruptive technologies, we tend to underestimate the amount of turnover and change that happens in an industry. And that has
Hmm.
to do with our psyche, where humans tend to think in a linear fashion. What happened over the past 5 years is kind of likely to do well going forward. But most likely, the top 10 companies today are not going to be the top 10 in 20 or 30 years from now.
Yeah. Even I think the period would be shorter, 5 or 10 years from now.
Yeah. Yeah.
So I
Right.
do appreciate that thought. That's definitely something for us to think and realize and understand. We kind of go with the trend often than understanding how it has been in the past and reevaluating and be cautious about it, right? So appreciate all the conversation. I think we have a lot of good nuggets in this conversation discussion that my team can ponder on more. We can have a further discussion, and I'll come back to you. I'll give you an update on how our session goes and any follow-up questions we might have or another podcast we want to do with you. So greatly appreciate your time, Daniel. And I'm looking forward to working with you from Infinity Forum perspective and also as my wealth manager. Appreciate everything you do for us. Thank you.
Usha, thank you so much. All
Thank
right.
you.
Great to see you as always.
All right.
Take care.